I'm really excited about making this video, which probably means no one will watch it, but where this really comes from was a combination of the book by Adam Ferguson, When Money Dies, and research from Ruffer, as well as a number of other sources along similar lines, and I'll pop obviously the links all down below. In essence, this was really looking at what's happened historically when it has come to inflation, and why it is okay that we should apparently be comfortable with money losing 2% of its purchasing power each year, as per the Bank of England target. And I'm not entirely sure where the 2% figure came from. I think it was locked in around the 1990s, but wouldn't ideally be zero. But anyway, the inflation game can go wrong, and the extreme end of this is hyperinflation, effectively that point at which money itself ceases to function as money, where it no longer has any purchasing power at all, where the trust is completely lost in a country's currency. We'll have a look at that and have a think about what actually occurs to get to that point, because it's such an extreme scenario when you're talking about an entire country utterly destroy its own currency, in most cases from an internal decision to potentially, and in some cases knowingly, destroy the currency. Recent examples have occurred in Egypt, Venezuela, Argentina, Turkey and Syria. It's truly staggering when you see the numbers involved. As an example, Venezuela has seen a cup of coffee increasing in price by over 373,000% in just 1 year. That's your medium latte going from £3.35 to an eye-watering £12,500. It's thinking about what's happening to politically enable you to get to that stage as to why no one stops it and who the winners and losers are in these scenarios, what assets offer protection and which don't. Firstly, what is money and what gives it any value at all? We can most succinctly break this down into the following 5 characteristics. Bearing in mind we aren't saying good money, just money. So it has to be divisible. So that is, it can be scaled for transactions large and small. It's no use if you only had one unit that could be held at any one time. Imagine a huge £100,000 coin that we would pass around. It would be useless for small ticket items. Number 2, durable, as in a store of value. Something perishable that could just rot or disappear will be no use at all. It's also got to be recognizable. Number 3, we have to be able to easily verify it as money, for example, so that I can potentially pass it to someone else and they can then recognize it as money, and so on. It's also got to be portable. It has to be easy to move. Using oil barrels or tree trunks isn't enormously practical. And lastly, scarce. This links really directly into what we are considering today. It should avoid debasement or dilution. The supply should be limited or at least controlled. In effect, anything can be money if it can be recognized as a unit of economic value within the system or between the group you are transacting with. We are therefore saying that if you and I agree something is money, then for that transaction it can be perceived as money. The issue is, if we suddenly change our minds, then the thing that I have received and I'm now holding that I thought was money and had a value and that I could then exchange again in the future doesn't have the value I thought it had. A curious example of this is in American prisons, where the decline of smoking has meant that currency has changed from cigarettes to noodle cups. And even now our money is predominantly digital. 96% of money held is done so electronically via bank deposits, and only 4% of money is held in real physical form of banknotes and coins. The reality being that the money we have is already just an entry in a ledger and nothing more than a digital footprint. A debit on one account to a credit on another, simply numbers on a screen being moved from one digital register to another digital register. We are therefore trusting that the register is accurate. The entire faith of that system and of the value of our money is reliant on a collective belief amongst all of us that the money we receive or send has a value and will continue to have a value tomorrow and the next day, and that it broadly meets those 5 characteristics that we mentioned previously. And all of this can be boiled down to one word: trust. However, this is something that should not be taken for granted. As Ruffer's note puts it, and I quote, "With seemingly never-ending deficit spending, quantitative easing, ballooning burdens of debt, and the increasing likelihood of outright monetary financing, governments and central banks are pushing their credibility to the limit. And perhaps what is curious here is how comfortable and familiar we are with the system in place that we could never conceive of any such break of trust and flight from a major currency. Even with the words such as those from the former chairman of the US Federal Reserve, Ben Bernanke, stating that the US government has a technology called a printing press, or today its electronic equivalent, that allows it to produce as many US dollars as it wishes to at no cost. Which is quite shocking given that this was somebody that was in charge of the bank that controls the reserve currency of the world. And seemingly, as inflation takes hold, the trust in the currency is eroded and the velocity of their money increases. The velocity meaning the speed which the money transfers hands. The impact being that £100 ends up doing the work of £1,000 that is used multiple times over a short period of time as people focus on getting goods rather than holding cash, and the process accelerates as the money seemingly loses value. Adam Ferguson's take on this is that in order to hyperinflate, the key of trust has to be lost. That this isn't something that occurs necessarily overnight, but it happens progressively over a period of time. In most cases of hyperinflation, it's taken a concerted effort to bring about the collapse, that prior to the collapse, there are individuals warning of what is likely to occur. In 1920s Germany, prior to the hyperinflation, there were economists warning of what was happening and what the likely outcome would be. As Adam Ferguson states, it gets to the point where it becomes politically impossible to halt inflation, that the necessary steps are too drastic and painful to implement, that the road towards inflation and subsequently hyperinflation is the only way forward. Central bankers, without exception, know how monetary theory works and what causes inflation, and so the only plausible reason that they could possibly follow a highly inflationary route would be for political purposes. The obvious step in most cases is to halt inflation, is to take interest rates above the rate of inflation. But imagine a scenario where interest rates were increased above the current approximate rate of inflation in the UK. A 7 to 8% interest rate on the UK economy would immediately pull the rug out from equities, bonds and property, and those would be the immediate areas impacted. The fallout being most severe on public finances, with the colossal interest payments that would become due on the government debt. It's clear then that with higher interest rates, the government would be forced into directly monetizing the debt, paying off debts and interest with freshly created money, as the interest repayments would eat up more and more of the income of the country. Inflation is really the only route for heavily indebted governments to pay down debt, especially where it is inconceivable that it should grow its way out, e.g. grow tax revenues to pay down the borrowing. Deflation arguably is a bigger risk to those with debts, just as inflation is negative to those holders of cash and fixed incomes. Added to this, isn't inflation itself a key factor in wealth inequality? Inflating asset prices such as stocks and property prices is hugely beneficial to the owners of those assets, but to the detriment of those that don't own them but see a reduction in their purchasing power. I would say it would be those individuals that rely on their incomes that would also feel the effects of inflation the worst, given how reliant they are on the basics such as utilities and food. It's odd that it appears acceptable to penalise those on incomes and with savings, much to the benefit of those with loans, mortgages and assets, arguably the speculators. And a curious point made by Ruffett in all of this is perhaps that it isn't an increase in the value of the property or the stocks, but perhaps it is the fiat currency, a fiat currency being one that is not backed by a commodity or asset, the denominator that is significantly falling in value relative to those assets. The money is declining in value rather than the asset appreciating. It's an interesting way to perceive money versus assets. And this is exactly what occurred in Germany in the early 1920s hyperinflation. Those with mortgages and loans could repay their debts in worthless currency. Speculators could borrow cheaply with almost limitless credit. Government's fear of unemployment was a greater fear, so there were incentives to build factories. These individuals could use cheap labour at home, export those goods and receive foreign currency in return, and they made vast sums of money. There are and always seem to be groups that benefited from and would lobby the government to pursue the highly inflationary policy. those that directly benefit from it. Those groups being the banks and speculators and exporters. As the inflation worsened, the holders of foreign currency, gold, tangible assets, shares could to some degree protect themselves. Losers were those that depended on savings or on a fixed income. An entire class of people were completely wiped out, and this led to food riots, political riots, unemployment riots. And towards the end of the hyperinflation, unless you had foreign currency, you couldn't buy anything at all. It eventually got to the point where the cost of printing the notes was higher than the face value of the money itself. Those in the countryside had food but didn't wish to sell it to those from the city. So seemingly there was this divide amongst communities, and this was similar in Argentina in 1991 when those in the city were worse off than those in the countryside. And what Adam Ferguson couldn't pin down was at what level we lose trust in a currency and hyperinflation occurs. It is possible for a currency to still function even at levels of 15 to 20% inflation and yet not need to be replaced. The consensus seems to be a figure of around 50% plus per month at which it is deemed hyperinflation. Just as we respond to things often in mass, much like a lot of the greed and fear we see, we do very often seemingly do things together as a group, often unknowingly. And this was popularized in the awesome book by Charles Mackay called Extraordinary Popular Delusions and the Madness of Crowds. Well worth checking out. And a curious situation where we seem to react to collective extremes of fear and greed, possibly a form of social proof when we look to see what our peers are doing, and this justifies our own actions. On the flip side, what was surprising was how well the economy recovered post the hyperinflation. Individuals were desperate for the economy and trade to work. Once a suitable currency was put into place that individuals could trust, once again some stability was found. However, and rather sadly, in the case of Germany, the seeds had been sown and the damage was done, allowing for an extreme political party to gain traction, and we all know how that turned out.